Hi all, I am Sham and I have Kishan with me.
Hi, Sham.
Welcome to Free Float, and today we'll be giving a very gentle introduction to hedging. Gentle in the sense we will not go into too many details, just a brief overview of what it is and how most people approach it, and who should do it and who should not do it. First of all, to give a brief intro of a straightforward way to hedge, I will pass the baton on to Kishan.
Yeah, so Sham, I think we all did a term of like hedging, right? And I think most people are confused by it because the question they ask you is how do you hedge, and me being me, I would tell them I tell people maybe you should most expected thing is to reduce exposure, but I also tell them that if you can't do that, then maybe you should go short, or maybe you should get options and stuff, and that goes into another rabbit hole, which becomes more like you are explaining someone the the dynamic of the market. So it always gets very complicated to explain how do you hedge, because versus that even the idea of matching, you could buy something that's totally, you could buy and short something that's totally uncorrelated, and both can go against you. So that becomes a very different type of hedge. Like like you could buy SPI and you could short Nifty, and SBI could go down and Nifty could go up, and it's got completely no correlation. So you could have a very bad hedge also.
Yeah.
And
So what
so
you mentioned, what you're saying is actually called basis risk, where you think that something is correlated and you put the trade on, and then later on they go in opposite directions. So it's one of the most common ways in which people blow up.
yeah, and so you might think that, oh, my portfolio is long short 60-40, or but the risk for this two portfolio is not are not like hedged, or they're not like you can say I'll go short Bank of Baroda and long SPI. This is them. Assume that they are highly correlated, and you might get that trade right. But if you get it, like if you long SPI and short ICICI Bank, very different stocks. So that's a very basic kind of hedge that I think everyone understands, that you have a portfolio of long and shorts, so that either way, if the market goes up, or if the market goes down, you believe that your portfolio will not fall, or will not, or yeah, your portfolio will not fall as much as the market. But if you get it wrong, you'll lose, like when the market's going up and when the market's going down. So
So I think
it
the post sort of describes a very simple way of hedging. So which is, if you have a portfolio, you calculate the beta of your portfolio against an index on which futures are traded. So in India, there are only two indices on which futures are traded, so which is Nifty 50 and Bank Nifty. So it makes your life a lot easier. You don't have to calculate too many betas. And at the same time, both of them are completely useless indices for for most of the time, because your portfolios are likely to be mostly mid caps and so on. So unless you have a vast majority of your exposure that are constituents of this index, of one of these two indices, then you have a huge basis problem. And there have been years when Nifty has tanked and mid caps have rallied. So you have to be careful as to not just mechanically calculating the beta and putting your hedge on, but you should be looking deeper into how these indices are constructed and what the composition of your portfolio is. But that is, we have kind of put the cart ahead of the horse here. So the simplest way most investors approach hedging is calculate portfolio beta. And if that beta is say 0.5, 50%, and your portfolio is say 20 lakhs. So for hedging a 20 lakh portfolio, you short 10 lakhs worth of Nifty or Bank Nifty, whichever you think is right for you. And the way you short it is, you basically sell the futures of Nifty or Bank Nifty. This is how most people go about doing this, and we've listed the problems with this. And the most common problem is trade maintenance. So this is not a set it and forget it sort of portfolio. Futures have expiry dates, and at expiry you need to roll it over to the next contract. So that is one problem. So it requires like constant attention on your part. The second thing that requires constant attention is this beta calculation. We've shown a rolling beta, rolling 1 year beta of a made up example portfolio. What you will see there is the beta itself is not constant. Betas go up and down. So you will see that in some cases betas have exceeded 1, which means you have to sell more of your Bank Nifty or Nifty futures in order to hedge your portfolio, which means you'll be net short. So these are the two biggest problems that common investors face.
Right.
So Kishan, how do you tackle this this beta problem? Any thoughts on that?
Well, I mean, so I don't really. So I think the best way to tackle beta is reduce your exposure. To make your portfolio less beta intensive, because if you're and which is not always the case, because some portfolios you will have like our all-star portfolio, you expect that to be extremely volatile. So the only way to do that is to reduce your overall exposure to that portfolio, so that you have a less volatile ride overall. So say you might be 67% invested in the strategy, and then maybe have 30% in cash, or in something which is like far less volatile, so that your overall risk is not your overall beta gets reduced in that way. I think that's the way I do it, because I think when you try to calculate beta, and beta changes, so and the thing is that also then you have to think about how do you hedge, and maintain that hedge, because it's fluctuating and it's changing. So I think that's much more harder to do.
Right. So my take on this whole thing is, if you're a long only cash and carry kind of investor, right? Hedging is probably not a good idea. You should try and get to a lower risk portfolio through asset allocation, rather than trying to do this sort of fancy stuff, because there's a lot more involved under the scenes, behind the scenes, so to speak, than just calculating beta and shorting the Nifty there. And the other problem is what we've seen around big events is that brokers hike margin requirements. So what happens is during the 2018 budget, some brokers hike their margin requirements, and during this 2020 Corona panic also, quite a few brokers required increase their margin requirements for this. So what that means is, say you have a 20 lakh portfolio, and you earmarked 2 lakhs to be short the Nifty, right? Now if your broker hikes that margin and that 2 lakhs become 3 lakhs, you need to figure out a way to come up with that 1 lakh, that extra margin that is required. And typically what happens is you'll have to sell down your portfolio to generate that 1 lakh in cash to meet that margin requirement. Now, what that means is during a panic, you're actually sitting there and selling stocks, in a downturn. So, so these are, some of the things that you need to keep in mind. That first of all, margin requirements are not static, and they tend to go up during periods of volatility. It may not sound like much when you're looking at smaller portfolios, because and smaller portfolios need to ask themselves this question, whether it is worth their while to actually hedge it. And second thing is, when we discuss using options to hedge this particular problem shows up as increased volatility causes increase in IV, which is basically means that your 200 rupee put costs 400 rupees. So so even though brokers may not be asking you for more margins, because volatility goes up, your option premium goes up. And when option premium goes up, when you go to roll your hedge forward, you end up paying a lot for it. So so all these mechanics come into the picture. So the bottom line is, if you're a cash and carry kind of guy, don't hedge. It's mostly for investors who are actually taking levered positions, right? So if you're maintaining a levered portfolio, then it makes sense to hedge. You will end up with better portfolio dynamics when you do this. And we alluded to this in our previous free float, right? So when we're saying we can actually have a levered version of the all stars portfolio, so you can use futures to construct that. So when you do that, then you can hedge some of the downside with nifty futures. But once again, you'll never get rid of that basis risk.
And do you think that but if you're a cash and carry investor, there are some strategies out there, right, that you can deploy to reduce the volatility of the portfolio, because say your objective is to reduce volatility, but you're only a long only investor, but you also do not want to see the 20% or 30% drawdown that happen every few years, and you're willing to offset those risks, but you don't want to be invested in bonds for whatever reason. You want to have a portfolio which is fully invested in equities, which appreciates by a decent margin every year, but you want to reduce the volatility.
Right. So I think we discussed this as well, like under those tactical allocation strategies. So that is one thing. The second thing we also discussed was degrossing, which is basically if you have as part of your portfolio construction, if you use trailing stop losses, right? So when volatility hits the market, your portfolio will not be 100% in stocks. The stop losses will be triggered and new stocks will not be added to your portfolio. And what we have seen is that during really turbulent periods in the market, some of our Momo strategies actually go to 100% cash. They're just sitting there in cash while the market basically goes all over the place. So those are two basic options.
Right. So you have like the Momo strategy, for example, have a stop loss which gets triggered, and then and then you wait for the market pick up when you start getting entry triggers. So
yeah, so it is based on the how individual stocks behave in the market. So for like small corrections, you might still take it on the chin, so to speak. The strategy will not protect you against say 5 and 10%, 5 to 10% drawdowns, because there's always some stock that will look like it is going up, but after you add it, maybe in a couple of days, the market sort of dings that as well. So there is no protecting you against 5 to 10% drawdowns. But in deeper sell-offs, what happens is all stocks get correlated to one and everything falls. So when that happens, this sort of trailing stop loss or or a tactical approach protects you from deeper drawdown. So I'm talking about 10% and above, right? So that is something that needs to be kept in mind as well. So you can avoid 10+% drawdowns if you do all these things, but hedging is not how you would do it. So once again, I would say, if you're a cash and carry kind of guy, focus on asset allocation rather than any of these fancy things. And the second thing to be noted is all these things increase your costs and taxes, right? So if you have a decently large portfolio, and I'm talking about 1 crore plus, in just equity investments, then it is worth to have a conversation about hedging. But for smaller portfolios, focus on asset allocation, make sure you're diversified into uncorrelated assets, and take a holistic approach, because once you consider taxes and costs and the amount of time you're going to spend maintaining these hedges, at the end of the day, it may not be worth it. So
yeah, I think you're right about that. That if your portfolio is not above a certain size, then you're hedging. The cost and the time and the effort required, you could probably achieve the same results with a much more simpler, approach.
Yeah. So with that, I think we'll wrap up today's free float on hedging. We will delve into a bit more sophisticated strategies sometime in the future, but basically this is it. This is all you need to know about what it is. So with that, we will bid you farewell until next week. Thank you for joining us. Bye.
Thank you.